Hello and welcome back to episode 3 of the Irish Home Show. In this first season, we're taking you through every stage in the house buying journey. So far, we've covered savings. In our first 2 episodes, we talked to money experts Kel Gallivan and Kaz Mooney. They gave us some fantastic tips about getting the right money mindset about saving for a deposit for a home, and also practical steps in how to put your money aside. If you're not already following them, I really recommend following them on Instagram. Kel is at Mrs. Smart Money HQ and Kaz is at Irish Budgeting. By now, you should understand what you need to save in order to buy a house in your area or in your target area. You're going to need enough money for a deposit, which will be, if you're a first-time buyer, at least 10% of the value of the house. And you're also going to need money for purchasing costs. Now, this week, we're going to cover all the rest involved in buying a house. And that next crucial stage, and often the most nerve-wracking, is mortgages. In a second, I'm going to take you through the basics of mortgages, our Mortgage 101. And then after that, I have a fantastic interview with Martina Hennessy. She is the managing director of Doddle.ie. They are one of Ireland's leading mortgage brokers. They are fantastic, not only what they do in helping people get a mortgage for their first or their next home, but Martina is also fantastic at spreading information about the latest in interest rate changes, mortgage applications, and eligibility in the Irish mortgage market. Finally, stay tuned to the end of the show where we go through our features in, out and away and new home versus old home, plus some of the latest news you need to know. If you're not already following us, please go to find us on Instagram at Irish Home Magazine. You can see all our visuals from the show, including any properties we mention here, and you can go vote on your favourite property in our in, out and away and new home versus old home features. If you're not subscribed to this show, please click subscribe wherever you get your podcasts, and if you get a chance, give us a 5-star review. It really helps us find new people. So without much further ado, let's get on with episode 3, Mortgages. So, what is a mortgage and how do I get one? That's a question I think a lot of you are asking, and I'm going to give you a brief overview of the mortgage process and how to get yourself set up for success when applying for a mortgage. I must first start by saying I am not a mortgage broker or financial advisor. I'm a lowly estate agent. I'm not qualified or regulated to give financial advice, but I've been through the process myself. I talk to a lot of experts all the time, and I see people out there in the mortgage buying process who are always giving me advice and tips on how they've got through it. So I'm going to pass those on to you now. First of all, let's cover what is a mortgage. Essentially, a mortgage is probably the largest loan you're ever going to have in your life, but it's also going to be the cheapest. Because the mortgage is based on an asset, your property, the banks can lend at a far lower rate than you'd normally get a loan at for a credit union or a car or a credit card bill. You can get a mortgage from any of the mainstream banks, and there are a few other lenders out there as well that you may see from time to time. You may think, I'll go straight to my usual bank. I've been with them for years. I'll go and get a mortgage with them. Sometimes it's best to just have a look around and see what's out there in the marketplace. You're not tied to the bank you've always been with. You're going to have to provide the same information and documents to any of them anyway to apply. So why not shop around? Or go on better and enlist a mortgage broker to go out there and find the best loan for you. While your bank can offer you a few rate options and different terms, a broker can assess the whole market, and they're also quite knowledgeable. They can tell you, look, that bank probably won't lend to you, that bank will get you more money, or that bank will give you a lower rate. So I highly recommend talking to a broker. When you're approaching a bank or a broker, they are going to first assess your eligibility for a loan. This is going to look into your income, your outgoings, and see how much they think you can afford to borrow. It can feel quite invasive, but look, take part in the process, provide the documents needed, and you hopefully will come up the other side with mortgage approval. Banks are limited to how much they can lend you. We mentioned it on one of the previous episodes. There are central bank rules that have been around since about 2014, which means that a bank can only lend you 3.5 times a multiple of your income. So our imaginary couple on 80,000 a year together, they would be able to get 3.5 times 80,000. That's about 280,000 euros. Plus their deposit, they could probably buy a house of around 308,000 euros. Now, the banks are allowed a few exceptions to that rule, and they can lend up to about 4.5 times your income, but they're very rare, and I wouldn't rely on getting one. All banks will also stress test how much you can repay as well. If they assign you an interest rate today, they're also going to see if you can afford that repayment in a couple of years' time, if that interest rate has gone up. They will take the monthly repayment that you're going to have to pay, and they're going to times that by at least 1.3 to see if you could afford that if interest rates rose. So if you were going to have repayments of 1,200 a month, they would say, look, can we see if they can afford 1,600 a month, just in case. A final important question is, how long will your loan be? That really depends on you. You can choose how long the term of your loan is, but it is limited by your age. They will try and let your loan run out before you retire, so at around 65. If you're 30, then you can have a 35-year loan that would take you up to retirement at 65. But if you're only 50 and now buying, you'd probably only get a 15-year loan with most lenders. It's something to be aware of, especially if you're buying later in life. If you're trying to repay the total value of a loan over 15 years instead of over 30, it's going to be a lot more expensive to repay every month. So where do we start with a mortgage application? Well, the key is to start at least 6 months, possibly even 12 months before you're planning to apply for the mortgage. If you're following on with our home buying journey, perhaps you're using our journal, you'll see we have you planning to save your money for at least a year before you're applying for a mortgage. Now, it could be 6 months if you can save that quickly, but you need a minimum of that to probably get your finances in order so you can make your best possible application. We'll talk about this in a minute, but the banks will ask for certain documents such as your payslips and your bank statements going back 3 to 6 months when you make an application. They're going to look through your account and see what you're spending your money on and whether they think you can afford the repayments that you're going to have with a mortgage. That means you have a chance to spend the next 6 months getting your accounts in order, keeping them nice and tidy, having the savings going to the right place, having all your bills being paid on time, and having no nefarious sort of paddy power statements or excessive bills on anything else going out. If you're working hard and saving away, you're probably being quite strict with yourself. And I know it is tough. We discussed this last week with Kaz Mooney. We don't want you to be completely restricting your lifestyle, but a 6-month sprint can put you in really good shape to get a very good loan and the house of your dreams. Once you've started out saving and being really careful with your money, the next step is to go and check your credit score. You can go to the centralcreditregister.ie and quickly find out your score. It takes a couple of days to come through. That is a good place to start to see how you're looking as a borrower to the banks. That'll take into account any previous loans, whether you've repaid them, any outstanding debts. This is a good opportunity to clear up your finances. If you have an outstanding car loan or a credit union loan, it'll be a good opportunity to pay them off. As we said last week with Kaz, you are better off to settle some of your debts rather than keep savings in one account and a debt in another account. Let them cancel each other out and just have savings accruing. The next trick to keep clean finances over the next 6 months before you apply for a loan is to make sure all your bills and direct debits go out on time and none of them are bouncing. The bank wants to see that you're going to be consistent and be able to repay your payments every month. They don't want to see bounced bills or credit card fines for being late payers. I joked about no nefarious things in your bank account, like betting or Bitcoin acquisitions. I know a lot of people may be into these things these days, but look, the banks don't look favorably on them at the moment as they are unproven sources of consistent wealth. So keep them aside and keep out of that for the next 6 months while you're applying. Now, the other reason why we're doing this so early is because it is really tied in with your savings. If you're saving a consistent amount every month, that is going to be proof to your bank that you can make the mortgage repayments. So if I'm putting away €1,000 a month, they can see, look, he has that €1,000, he's not using it for anything else. That will be the 1,000 that's going to go to mortgage repayments. However, don't forget rent will also count towards that. When you buy a home, you're not going to be paying that rent anymore. You'll have moved out of that rental property. So if you're only saving €500 a month, but you are paying €1,000 a month on rent, there's €1,500 the bank can see that you're going to be able to make repayments with. All that rent you're paying isn't wasted. It is good proof of income, even if it isn't going into a savings account every month. You can never be too early enlisting the help of a mortgage broker. They can sit you down up to 6 months before you make an application and go through your accounts and see what you're doing right, what you're doing wrong, and help you to correct it in time. They will also prepare your application so you have the best possible chance of getting a loan or getting the best possible loan. Don't panic if at first you don't succeed. You are always able to go back and make another application. Spend another few months saving. You'll always look a little bit better on paper every time. Don't forget to shop around, whether with banks or with your broker. There are different banks that will lend different amounts to different people. There are green loans with cheaper interest rates if you're buying a B3 or above house. There are different loans if you're self-employed and different banks that you should perhaps look at. Don't worry about the exact interest rate you're going to sign up to right now in this process. You won't fix that in stone until you are much closer to having a house sale agreed and closing the sale. Interest rates might change between now and then. A good broker will keep you informed and find you the best rate at the time. Finally, one crucial thing that everyone forgets about when applying for a mortgage: mortgage protection and life insurance. I'll be talking to Niall O'Connor from Beat the Bank in the next few weeks. It's something that everyone by law has to get when they're taking out a mortgage. It essentially is an insurance policy to cover if you get sick and can't work, or you lose your job, or unfortunately if one of you passes away. It allows the loan to continue to be repaid. It is a requirement. You're going to have to get one. It shouldn't be too much of a problem. But for some people, if you have perhaps a pre-existing condition, you just want to get in there early and see if you're eligible and you can qualify. It can be something that can scupper your whole purchase right at the last minute if you've forgotten about it. And it's also worth shopping around with the likes of Beat the Bank so that you can get the best rate, rather than just going with the one that your bank pushes on you. Now, enough from me. Let's go talk to Martina Hennessy from Doddle.ie and get her expert advice and up-to-date information about applying for a mortgage in 2022. The Irish Home Show is brought to you by Irish Home Magazine. We're your online magazine for Irish homes and property news and information. You can find us online at irishhome.ie. There you'll find all our extra information around this show. In this episode, we're talking mortgages, and we have a great mortgage application checklist you can download for free over at our website. Just visit irishhome.ie/free to get some of our free resources. You can also go there and buy the Irish Home Buyers Journal. There's a special discount for show subscribers. Just use the code SHOW, SHOW. So today I'm joined by Martina Hennessy, who's the Managing Director of Doddle.ie, who are one of the leading mortgage brokers in Ireland. Martina, how are you?
I'm great, thank you, Ben. Great, thank you for having me.
Good, no, it's a great pleasure. As this series of my first season of the Irish Home Show is designed to guide mostly sort of first-time buyers through the process of buying their first home. We'll have covered savings. The next major step is obviously getting a mortgage. It's probably one of the steps that is most daunting for buyers who are fresh to the market, who are wondering, can I get a mortgage? What am I eligible for? Is there any hope that I can, buy a house and afford something at the moment? Is it really scary to get started on this process, or how do you find it?
Yeah, but I think for anybody who's spent so much time saving, has made so many sacrifices and trying to build up a deposit, when it comes to the mortgage stage, things like fingers crossed, going, I hope this works. I will get what I need. I hope, I can borrow as much as I need to buy where I want to buy. So it is stressful for people, and it is daunting for people, especially. So until they have their approval in principle, they're very nervous about whether they'll be able to borrow the level they need to, because again, we're restricted under central bank lending rules at 3.5 times multiple, which is restricted for a lot of people who want to buy in the urban areas. So if somebody's looking for an exception, it really has a big impact. The level they can borrow obviously impacts how much they can spend or purchase on a new home. And so therefore it is scary for people who are going through that mortgage application process until they have the approval in principle in hand, they're very nervous. So that, I think that's to be expected. I think a big thing about that is just to understand what's required and what the process is, so that when you come to it fresh, you kind of know what to expect. You know the timeline of when you might get approval or what might be required for you. So it's all about, I suppose, getting organized, making sure your ducks are in a row, and I suppose getting in early, getting some advice as to what's required to make a successful application. It makes it so much less daunting rather than going, God, I hope I've done everything right when you're about to submit the application, as opposed to have planned for it. So the big thing is always planning, and it makes it so much less daunting.
Well, that's all of that exactly what I want to cover. So the first step, I have a couple or someone saving up on their own. They may be halfway to their savings goal for their deposit. What is their first step? Do they go to their bank that they may have been with for 10 or 20 years? Or do they come to someone like yourself, a broker?
Oh, I'm going to be slightly biased on this, but I suppose what I would say is, for anybody who's looking to get mortgage approval, there's so many different, even though there's not so many banks, okay, and two have left the market recently in terms of mortgage lending, there are so many options that are still there with regards to how much you can borrow, with regard to mortgage interest rates, with regard to cashback offers. And I think if for anybody who's looking to take a mortgage, the worst thing they can probably do is just go to one bank, their own bank, because their own bank can only tell them what rates and terms and offerings they have, relative to what they can offer them. But they cannot tell them that the bank on the other corner, they won't tell them that the bank on the other corner has a better range, or they could borrow more potentially based on different underwriting policy. So I suppose that the advantage of a broker is that we offer market-based advice. So when you come to a broker, they will look and say, okay, well, what are you looking to achieve? How much are you looking to borrow? Do you need an exception? Are you looking for cash back? What are you looking at in terms of rates? And you try and refine. So when I speak to a client, I'm always trying to think, okay, great, get that. And you're trying to refine in your own head what will suit the client best. And then you really go back out to the client with the information saying, look, based on our discussion, this is how I think we should approach it. These are the areas you've expressed concern about, or you're nervous about, or, you don't think you might be the ideal candidate because of. But look, these are the positives. And you're building a profile. So as brokers, when we're submitting an application, or any mortgage advisor, whether it's with a really good mortgage advisor in a branch or with a broker, what you're doing is you're just trying to establish what the requirements are for the client and what the bank will want to see. So when you're making a mortgage application, it's really important to know how the bank assess it, because we all hear stories of, oh my God, the banks, they don't want to lend. They do want to lend. That's how they make money. But they can only lend from a consumer protection point of view, where they can see that income is sustainable and where they can see that you have repayment capacity, that you can show that you can afford to repay the mortgage that you're proposing to take out. So I suppose they're the things to be mindful of when you're making an application, when you're preparing to make an application. If you're looking to work with either a broker or directly going to your branch, do it early enough so you have a sense of what the requirements are. But I think if you're going to your own bank, it's really important also that if you're not going to go to a broker, you're going to look at market and you're going to do your own research. You can't just go to one lender, because there's such a variance between lenders and rates and options on the market at the moment. You'll only get one set of advice, and you'll only get one figure in terms of how much you can borrow. That's that lender's criteria. However, there's the other 7 lenders that are available to borrow from. You won't get their insight as to what you could borrow from them, what their rates are. So it's really important to either do your own research or to go to a broker who will offer you that market-based advice.
Yeah, I think that's really good advice. It seems like, although everyone hears about this 3.5 times your income figure, which is sort of the cap set by the central bank, it does seem that the banks vary on what they'll offer you. I put in I did it for myself just to see what I would get these days, and whatever bank it was would only lend me sort of 2.5 times. It depends on you. I've got 4 kids, so that's the problem. So it really depends on your. Yeah, so
we're out of the market.
We are. Thank God. I wouldn't have afforded it. I moved into this house the day our first daughter was born. So after that, it wouldn't have happened. But it does seem that the different banks have different affordability tests. And as you say, with a broker, they'll be able to say, well, look, this particular bank would be better suited for you. Perhaps if you're in a certain profession, or if you're self-employed, I understand some other banks are better than others. So at least with a broker, as you said, is an independent advice, and like a financial advisor, as you guys are as well. They can give you advice saying this is the best bank to apply to, and this is how to process that application to get the best result.
Yeah, and from a broker's perspective, a broker gets paid when you draw down your mortgage. So effectively, as brokers, we get paid a commission by the lender you choose to take your mortgage with. But to be really clear, it's the same commission we get regardless of the lender, and the same rate you get by going to the lender or the bank directly. So I think sometimes people go, oh, where's the catch?
That's it. There's a kickback or something, but you're in it to win it.
Yeah.
You're sort of
Yeah.
no sale, no charge. You're if you don't get the mortgage through for them, if you don't successfully process that application and get them all the way to a house,
Yeah.
you don't get paid either. So you're in it for success. Yeah,
Absolutely.
very
Yeah.
good, very good. Okay, so we're going to go to a broker. I'm going to turn up, and maybe I've been saving for the last 6 months, 12 months, 24 months, whatever it has been. What am I bringing to you that I need to show you my proof of everything? What is the shortlist?
Yeah. So absolutely. So the banks always, when they're lending, they need to look and say, what's your income? How can you show us that your income is sustainable? Are you in permanent employment? Are you on a contract? So first of all, looking at the income documentation, we have to provide a salary cert to the lenders, and that shows what is your income. It's certified by your HR department, stamped to say you've earned X gross basic, you had a bonus this year, did you have a bonus last year? Do you have overtime? What are you earning currently per your contract? And what have you earned in the past? So what bonus did you get last year? Did you get one the year before? Because a lot of lenders, when we're looking at that 3.5 times income multiple, where they can vary is if you have variable income. So if you have variable income, they'll say, okay, we'll take Bank A might take 50% of last year's bonus. Bank B might want to see it for 3 years and take an average. So that'll determine based on how much you want to borrow. We will, as a broker, we would look and say, well, okay, this Bank A will lend you X, Y, or Z. But the income documentation is the first bit. So 3 months bank statements, salary cert, and an EDS. So it's EDS is the old form 60 that shows your income for last year right up to 31st December. In some cases, if somebody's just newly joined a role or if they're on a contract, we might look to get a copy of that contract or give some background information as to that person's prior employment, their education status, just again to beef up the fact that the banks are looking at how sustainable the income is. So if you're in a new role, they'll want to know, well, what did you earn in your prior role? Is it consistent, or have you taken a massive leap in salary, which might indicate that maybe it's a little bit riskier to take that salary when you just higher salary, just in a new role. So we'll do a lot of work on understanding what the client's current position is with regard to income. And then we'll also look at evidence of repayment capacity. So the income documents are payslips, salary certs, EDS, which is the equivalent of your old form P60. Then we look at the bank statements. And this is every stuff. Oh my God.
Scary bit. Yeah, this is what people freak out about.
I know. Yeah. And actually, all the lenders are trying to establish is first of all, see your income is going into your bank statements, and that's all clear and consistent and clear and clean. And then when they look at repayment capacity or evidence of repayment capacity, they're not trying to say, gosh, it's always, having the Chinese on a Friday or love Zara.
I'm sure they love looking through that.
They're trying to see.
And seeing your habits.
Yeah, no, absolutely. But I suppose they know people live. So all they're trying to see is what can you show us over the last 6 months? It's a really clear window of the 6 months prior to application that you can afford the proposed mortgage. So if you want to borrow 300,000, how can you show us, as in the bank, that you can sustain that mortgage repayment based on your track record of the last 6 months? So as a really broad rule of thumb, I would say for every 100,000 that you want to borrow, you should show repayment capacity of 500 euros per month. So if you wanted to borrow 300,000, show 1,500. And that kind of will get you over the line with almost all lenders. And that can be the rent that you're paying now, savings on a monthly basis, or if you had a car loan or a personal loan that was going to be discontinued, that can all be taken into account as repayment capacity or evidence repayment capacity. And the banks look at really narrow window of the 6 months immediately preceding application. So sometimes clients say to me, but I had my full deposit, so I stopped.
Yes, I know. Yeah.
You can't do that. So it's, really right up to date, current, consistent savings is what they want. Or in particular at the moment, the weddings have been for the majority of people who are buying, the 34-year-old brigades, they have multiple weddings a year, and weddings have been postponed. So they go, well, I had a wedding in July, June, 3 in August, I had 2 hen parties. And so therefore they didn't save that month.
Yep. This is a year of weddings, apparently, and that's €1,000 every weekend.
You're dropping your normal habit. You're dropping your normal habit of saving. Of saving. So it's trying to just keep that consistency. Be aware that it is, even if you have your deposit, it's that 6-month window that you just need to be mindful that don't deplete your savings, don't withdraw funds, for holidays where possible. Keep your savings consistent. Park them. Standing order, direct debit, whatever it is, out every month, and try not to touch them, because that's what the lenders are looking at. And even if you miss 1 month within that 6 months of savings and don't show repayment capacity, the bank will go, well, your mortgage has to be paid every month, so you need to keep this consistent. Even if John and Mary were getting married in Spain, they do. And outside of that, and once you show repayment capacity for the proposed mortgage, the bank have no great issue with whatever else you spend your money on, whether it's discretionary spend on clothing, whatever, lifestyle. except for the obvious, which we all hear about, the increased credit risks of like,
Gambling.
betting or, a large, yeah. So like, but they're the normal, like if they're in your statements, you're not mortgage ready anymore.
Fine. So they're looking through the major things, and it's worth reiterating the point that there's savings and rent, and obviously if you're
Yeah.
trying to show that you can save 1,500 a month, for example, if you're spending 1,000 a month on rent, if you're a lucky few who can rent something for that much, and then you're saving 500 on top, that counts. That's 1,500 quid, which they know is absolutely savings,
Absolutely.
which would be to your mortgage, because obviously you
Yep.
won't be renting anymore when you move in. So that's the
Absolutely.
most important thing. And
Yeah,
then major
exactly.
outgoings, things like childcare, I presume, any other loans, all those sort of things. But they're not going to sweat the small stuff, is what you're saying, as long as it's not too overwhelming.
No, exactly. And they're not trying to catch you out. They're just trying to see that it's really clear. And I suppose the clearest way to show repayment capacity is if it's your rent, make sure it goes out by EFT from your account so that there's no cash payments. And then if it's savings, just try and keep it consistent to one account, or, that you can see that it's a build up in that account as opposed to just in your current account. It's always a good discipline, I think, to transfer the savings amount out, because otherwise it gets muddied. And, 1 month you might have something allocated in your salary for a particular spend or insurance or whatever. And it doesn't keep it as clear and consistent as it should be. Transfer it out to a savings account, leave it in the savings account. Don't have too many savings accounts. Like I will have clients who put
You have all the bolts and things like that in everything.
and then you're trying to get your
They're very hard to read. Those
yeah. And you're trying to get your documentation. Yeah, it's hard to get it. So from a documentation point of view, bank statements, 6 months current account statements, 6 months savings statements, and that's all statements. So that's not just your main current account or your main saver. If you have a credit union account, they'll want to see that also. ID and address verification are also required. And if you have credit cards or loans, in general, the lenders can now see those on what's called Central Credit Register. So it's a CCR. So they will run a credit check and they'll be able to see there's a lot more detail on the CCR than was on the old form Irish Credit Bureau, which was the prior, I suppose, reporting tool for the banks. So they can see your mortgage, your credit cards transactions for the last 24 months. They can see your loans. So they get a lot of information from that. So it's mainly the current accounts and the savings accounts that they're really focusing on when it comes to application.
What about those other loans, credit card, car loan, or credit union? Are they big red flags, or as long as they're being paid and you're still within, you're still saving what you need to save, is that okay?
Yeah, but I think from the point of view of any form of credit, so if you have an overdraft on your account, and many people would just say, well, look, it was on my account, I go into it, I clear it every month, I get paid, I go back out of it. Yeah. It's better off to try and clear your overdraft. So your account, it is not overdrawn, because it's not seen to be a positive, even though it was there 2 years ago and you've still had it and just let it roll. It's better to clear it and just come back into a positive position in terms of your bank statements.
Sure.
In terms of cars and car loans, the banks are aware that people will have car loans, but I suppose the big thing is the level of the monthly repayment, because when the banks are looking at how much you can borrow, they look at your net income and they take a portion of that as being able, or the ability of that to service the mortgage. But if you have a car loan, they will take that car loan off, and a net amount is what can be used to service the mortgage. Credit cards, if you have a credit card, just make sure, or at least try to ensure that it's cleared off monthly, that there's no big rolling or sitting balance there, because that's not viewed positively either if you're just paying minimum balances and it's a large portion. The credit limit, or the balance is a large portion of your income. It's not seen as a positive. So those type of things are things just to be mindful of. So as well as saving, it's trying to make sure you everything kind of at a happy medium. You're trying to save, you're trying to pay your rent, but you're also trying to keep your debt at a minimum. So just being aware of what's the bigger priority. Sometimes don't overstretch yourself on your savings. That could be to the detriment of your not paying your credit card, or, putting your account into a detrimental position in terms of overdraft. So it's that happy medium that an advisor should be able to give you a steer on also.
Yeah, that sounds like a good point. Keep your savings at a level where you can consistently save that amount without having to dip into it. So an emergency comes up, you don't have to, I need to take €500 out of that savings account. Let that savings account sit, even if you're not quite putting as much into it every month as you might be able to in certain months. Yeah.
Absolutely. And the ideal, yeah. And you're better off having it as a consistent amount. And then if you can, top it up. If you've got a bonus or overtime, then it shows that you have more. But keep that standing more than the same, and try not to take any money out of it, in particular in the 6 months immediately preceding application.
Okay. Yeah, so you've done your 6 months then. We've been golden boys and girls, and not done any gambling, not done any, not gone to any weddings, not gone on any holidays.
Oh God, this sounds really bad. No lie. No.
Complete to the priest for about 6 months before we made the application. And then so we put in our documents. How long are banks sort of taking these days to process an application? How long will I know if I have a proven in principle?
Yeah, it's a tricky one at the moment because the banks are all extended in terms of their volumes. Because we've lost 2 lenders, KBC and Ulster, what would have normally been a 10-day, approval time turnaround, 10 working days approval turnaround is now gone out to 4 weeks with the lenders who have the really strong rates. So it's just be mindful that it can take time. If the lender comes back with a query or there's something on the CCR that you need to clarify or whatever it might be, it can take a little bit of time. So I would say, expect it to take 4 weeks. It will take probably less than that because the banks are really catching up. There's also been a surge in switcher applications from, again, the existing lenders. So that's put strain on the lenders throughout their whole process, whether you're a first-time buyer or a switcher, whatever it is, whatever kind of product you're looking for. So just be mindful of that. It takes a little bit of time. And in terms of when the approval actually issues, it's valid for 6 months with some of the lenders, but some of the other lenders have now started to extend their approvals out to 12 months. Which is great because then at least you have that approval for 12 months. Then you will have to submit additional documentation once you go over the 6 months. So even the lenders who have the 12 months approval, you'll have to still submit a pay slip and up-to-date income docs and, our pay slip and up-to-date bank statement, once you go over the 6 months, just so they can see it's the same. So the one thing to call out is when you have your approval, they placed reliance on a point in time when you made the application. So just be careful and conscious that any changes that you make can impact that because it's only approval in principle. So if they want to see your savings account and you can see a massive depletion of the savings account after approval because you went out free, or if you've changed jobs,
don't do that.
Just be mindful that until you draw down your mortgage, they're still going to review your application at intervals, or they can ask for additional documentation. So just be careful of that because sometimes people change jobs and they go, oh my God, I didn't think it would make a difference. I'm on a better salary. But it would make a difference if you probationary periods within that new role. So things like that, discuss with your advisor.
So you're saying we've gone from 6 months of being good to maybe 12 months of being good from when you 6 months to get approved, and then after I did a poll the other day on our Instagram of how long it took people to find a house from being mortgage approved, and I'd say about 50% of the responses were over a year, and 20, 30, 40 viewings. People took because there's so little on the market at the moment. People are taking 6 months, 12 months to find the right home or to win the bidding. So I had something the other day from Bank of Ireland with a mortgage from Bank of Ireland, and they had 12-month approval, and it was so much better. She was so much more relaxed. She could say, look, I like this apartment, but I don't need to rush in to bid on it right now. I can take my time. There might be more property coming on in autumn. Yeah. I said, absolutely. And you'll find others who go, I need to get this agreed next week because my mortgage approval is going to run out and I don't want to go through the whole thing. So no, certainly the longer those mortgage approval periods can be, I think it's better for everyone involved.
Brilliant. Yeah, we've been absolutely lobbying the lenders to do that. So Bank of Ireland and Avid both have 12 months, but we're trying to engage with the other lenders to say, look, this is the market. It's not that anybody is just trying to
too hard to buy.
It takes that length of time. And like you say, we would have clients who would have got their approval last year that will be coming back for reapproval now. And it is much the same process. You still have to show your income and your affordability. So it's just being mindful. It's not that you have to really lock down your life for a year until you buy, but it's more so just being conscious that just because you have approval doesn't mean that the bank can't come back to ask for something. You don't want to be disappointed in 6 months' time thinking, oh my God, now I have to wait another 6 months before I can get, things in order again to apply. So just be conscious of it is what I'd say.
Okay, great. So we have a couple who've applied for their mortgage and say they're on between the two of them 100,000 a year. Typically, they should be able to borrow 3.5 times their income on that 350,000. What if they needed a bit more? What if they couldn't find anything in their area? They're buying a new home and nothing really is on the market for less than sort of 450. What are their chances of getting one of the few exemptions that they're allowed from the central bank?
Yeah, I was going to say exceptions are very popular, but that's not the right word for them. They're much sought after. Okay, so all lenders can offer loan to income exceptions, which is the exception you're talking about there. They can offer loan to income exceptions on 20% of their book of business. So a bank can go above the 3.5 times multiple of income on 20% of the mortgages that they do, right? So I suppose from the point of view, if that couple felt, it was affordable for them to go a little bit higher, that they were just being constrained and their incomes were going to increase, and the affordability was there, and they wanted to apply for an exception, then absolutely they could do so. So, depending on availability with the lenders. So at different times of the year, the lenders might pull back an exception. So they might say, God, we've given an awful lot out this quarter, and they'll pull back. And how they do that is they make it more difficult to get an exception. So but at our point, and I suppose again, from a broker point of view, because we're dealing with multiple lenders, we'll know who's open and closed for exceptions. Some other lenders will only allow exceptions when your sale agreed, because when they bank that exception on their side, and I know this is going to be frustrating for you, Ben, as an agent, but when they bank the exception on their side, they then can't. It's like, so that if they bank the exception on their side, they have to hold it for that 6 or 12 months. But it's a real chicken and egg. It's like, well, how do I know how much I can borrow if I can't get the exception banked? Yeah.
Now, I can understand that it just can't work for their system because they have all these exceptions tied up for people who may not find a house within 6 months. So I understand, but it is my sister-in-law recently bought last year, and they managed to get an exception, but they didn't know they were going to get it until after they were sale agreed. But obviously, they were making offers on a house they couldn't afford if they were only going to get 3.5 times income. So
And that's not great for the market. Yeah, either.
no, I guess not. I guess it's pumping up prices a bit as well. It was only that their broker had reassured them that, look, I can see your income there. I think you're going to be okay. Yeah. And so what is the best way to prepare yourself to make it look like that you are the best candidate for one of these exceptions? Is it just having low expenses and you're saving a certain amount, you're earning a certain amount, but is it that you can save a lot more, you have a better affordability, ability to repay? What's the best way to get
and it's, there's no magic rule about it. It really comes down to the banks will increase the multiple of income. So from 3.5, they'll go, some lenders will only go to 4, some will go to 4.5, 4.75 times, depending on your income. So if you're earning, less than 40,000, it's difficult to get an exception. If you're earning, 60,000, it's you probably could go to 4%, 4 times multiples of income. If you're earning above that and you've really strong income, they'll generally go higher. So it's down to their own underwriting policy. So if they're giving you an exception to central bank lending rules, they park the 3.5 times to some degree, and they look at your net income and the portion of net income that's servicing the mortgage. So they generally won't go over 50% of your net income.
Of course, yeah.
Mortgage, the proposed mortgage. So they'll work it that way as opposed to a gross multiple of income. And so in terms of how to get the exception, it's down to availability a lot of the time. So, but it is also income, but not on a how can I make myself in a better position relative to with regard to income, because income is income, and it's just what the lender will allow you on the basis of their own underwriting policy. And then affordability has to come into play. So if you're looking for a mortgage of 400 instead of 350, you have to show that to achieve the exception, you have to show, like you would for any standard mortgage application, that you can afford that 400,000 by way of a stress tested evidence of repayment capacity. So that 500 euro per month for 300, that was 1,500, has to then go to 2,000 a month to show repayment capacity. So again, the lenders again do want to lend, and if they have exceptions and if they feel that the applicant has showed the affordability and has that strong sustainable income, they will grant exceptions if they're available once the client is sale agreed in most cases. There are some lenders that will offer exceptions without having to be sale agreed. So, there's different options there in market. Different lenders take different strategies, but there's no, I suppose, golden ticket or golden route to actually getting an exception. It's just, again, looking at the different lenders' policies, and sometimes people don't need the exceptions. So again, coming back to that allowable income, you might have had 3.5 times multiple of your gross basic. And then since you've gotten a bonus or overtime, and maybe there's more that we can get under that income multiple without having to have an exception. So we would always work through that with our clients before we would go for an exception, just to see, well, this is your max. And then we know that once you secure a property, if the exceptions are available, Bank A will give you X, Bank Y will give you Z. And you'll know, and that's again, like your sister-in-law, you can give the comfort of saying, all things being equal and the exceptions being available, you would be eligible for an exception of X amount. So that gives you some, I suppose, leeway. The big thing, I suppose, is it's really difficult when you're bidding at the moment not to kind of say, oh God, extra 20,000 or an extra 25 will get me to where I need to be. And I totally get that. It's so difficult. But then I suppose it's trying to maintain that along with, I suppose, what the repayments are, what your affordability is, and kind of where you want to cap things.
Yeah, sometimes, the bank may lend you a certain amount, but just because they can, maybe you really should think, maybe should I? Will I be able to afford this? Am I going to have to cut back on, keep living like a monk for in the next 10 years or 20 years because I've really maxed out my repayments every month and I have nothing else to spend. So yeah, sometimes you're better off just sort of mediating that a bit and say, look, what can I comfortably afford rather than what will they give me?
And it's hard. It's really hard because again, such a challenge at the moment to buy property prices. And, if you can see a property, especially new builds, and you look at them, you're kind of saying, oh God, there's so much more, they're expensive. So it can be that challenge
They
of
are,
trying
yeah.
to maintain your budget where you want it to be, but also securing that property. So it is a difficult one.
Okay. Okay. Now, finally, let's move on. One last question. You've got your mortgage. You've got the sale agreed. And I think at that stage is going to be your final decision on what type of mortgage you're going to get. You've probably been coached by a broker. You've probably looked at sort of comparable rates during the course of your house hunting journey. But it's really only when you go sale agreed that you finally have to sort of sign on the dotted line. What's happening with interest rates at the moment? What are people choosing? And what's the future for that?
Yeah. So absolutely. When you go sale agreed, you decide then you go back to the bank that you've looked at and selected. Or first of all, you speak to your mortgage advisor and think, is this still the right bank for me? Because it might have taken time for you to get your approval in place. Rates might have changed in the meantime and your requirements might have changed. So you kind of do a recce on, does this still make sense with the lender that we're proposing? Then you start looking and saying what the rates are, what are the rates like? So right now, rates are the lowest they've been for 14 years. But there is an imminent increase in the ECB base rate,
Yes.
and funding costs for the banks have increased substantially over the last 6 months. So it is expected that rates will start to increase. So even now, when you're doing your own budgeting, and we would send rate schedules out to clients that can be adjusted, you need to bear in mind that these are the lowest rates and rates will start to increase. So a lot of our clients, when they're looking to borrow now, especially as first-time buyers, they want to lock down security. They want to know, what would my rate be every month for the next 5 years, for example. And the only way to lock down security is to fix your rate. So there's two types of rates. There's variable rates, which can increase or decrease at the lender's discretion. And then there's fixed rates, which are fixed for right out to 30-year terms. So the market has changed quite a lot in terms of rates, especially over the last 2 years, because the introduction of Avant Money, Finance Ireland, ICS has meant that there's been a wider range of products on market
More
and
competition.
at a more competitive level. So you can get mortgage terms that are fixed right out to 30 years, which is like a year length time. Yeah, we could never get this before it was 10 years. But the thing is, they're keenly priced, and the downside of fixed rates at that length of time are that sometimes there could be, there's a break penalty potential. And if you break out early. So they've capped those break penalties and there's overpayment options. So a lot of the lenders have addressed some of the concerns in relation to longer term fixed rates, and they're priced well. So right now, and historically, I should say, we've been a nation of short term fixers. So we fix for 2, 3, and 5 years. We say we worry about it. That's fine. Yeah. So now a lot of our clients would be looking at 5, 7, 10-year fixed rate just to lock down the security on the basis that we do expect that rates will increase. And again, because we're in a timeline right now, we're at a 14-year low on rates. The only way to some degree is up on rate movement. Okay. And that's not being, I'm no economist, but again, being in the market and knowing funding costs and speaking to the banks, it is, I suppose, a necessary evil, but there will be an increase in rates. So again, somebody was looking to take out a mortgage now. Really do look at those, for me, I would say to my clients, you really should be looking at anything shorter than 5 years. And you should be looking at those perhaps long-term fixed rates or long tail fixed rates. Sometimes people say, God, well, what if I move? Will I, and generally mortgages are property specific. So you take out a mortgage, you sell that property, that mortgage is cleared. Some of the lenders, including Finance Ireland, will allow you to port your rate. So if you have a 10-year fixed rate, you're locking it in now, and the rate is really good because it's low right now. You can port that mortgage to a new property if you did move on. And that's a really big benefit because you're getting the rate now for a mortgage in the future. So there's a lot of different things like that while rates are low, that, mortgage holders or, mortgage hopefuls or whatever you might want to say, should consider as to how, you might be best to safeguard your own financial interests go forward, because there will be rate increases over the next at least 2 years. We'll start to see a lot of upward movement.
Well, I remember when I think I first bought a house in London, interest rates were 4%, something like that. And then they came down very quickly during the last recession and have been at next to zero for the last 14 years or so. So yeah, it really does. It does seem like the 10 years or even 20 years are almost no-brainers at that point. As long as, again, as you say, you read the fine print. Can I move? A lot of people are buying a house which they think will be their forever home, but you never know what changes. You might decide you may have a couple more kids. You might need a bigger house in a couple of years, or you might relocate from work. So it's good to know just what are my break options. If I do need to move it, am I going to be stung, or, can I get out of it?
Exactly. And I suppose if you're locking down for that kind of longer period of time, again, the big call out would be do your research. Don't just take the first rate you get, because there's such a difference between rates on market that if you're locking in for, say, 5, 7, 10 years, if you're paying 0.5% more than you should be, or unnecessarily paying it than you could get with another bank, then you just need to that's going to cost you a lot. So if you're locking in for a longer period of time, just make sure you understand what other rates are on the market for you, what you're eligible for. Because I think sometimes as first time buyers, we feel like, you feel you're not in control, and you're kind of just happy to get the mortgage. You go, God, they'll have it.
You'll take whatever money they'll give you. Yeah, that's the situation I probably was in.
Yeah.
Just, whoever will lend to me, whatever rate, I don't think I even looked at the rate at the time. I just signed, give me the house. Yeah. So, but it can make a big difference. So say on a €1,500 mortgage, obviously a variable at the moment would be 1,500. A 5-year or 10-year tracker, the monthly repayments might be €100 more or something like that.
They'd be substantially lower. So if we look at it so we're kind of saying, for 2.5, there's 2.5% difference would be €100 a month or €135 a month for every. So it's roughly at €50 a month extra you would pay for every 100,000 that you borrow. So just to be mindful of that, it's a big difference, because when it's coming out, we sometimes think of our mortgages as tax, just, oh God, that has to be paid. Yeah. But really, it's coming out of your net disposable income. It's so important that you keep it as low as possible, because you look back and go, oh God, I could do with that. It's at some point. So
absolutely, it's very hard, because probably when you're buying, if you're a young person buying, you're probably hoping to earn more in the future. But right now, that could be quite a lot of money, an extra couple of €100 here and there.
Needless interest. It doesn't add anything to you or your mortgage, so you're paying it unnecessarily. So it's not like you're getting any benefit by paying that. You're not. It's just a cost. Interest isn't necessary even. You always have to pay it when you're taking out a mortgage, because nobody lends free money. Maybe somebody might come in and make my job a lot easier, but nobody lends free money. So if you're taking out a mortgage, it's so important to make sure you have that rate as low as possible.
Brilliant. Okay, Martina, that's fabulous. I think we've covered everything for a first-time buyer getting on the market. It's a good time out there, I think, for people to get mortgages. If they can find a house, even better. People can find you if they need to apply. You are at doddle.ie, doddl.ie, no E. And where else can they find you?
Yeah, well, our website has hopefully got a lot of information that might help, but we have a Let's Begin section on our website that literally goes straight through to an advisor and contact you in 24 hours.
Great.
All of our advisors are normal people. You can tell them the warts and all version of what you want and what's happening in your life at the moment, or what you expect to happen, and they'll just try and find the best option for you. So don't be daunted by the process. Everybody has to go through it at some point if they want to buy. And you know what? It's the banks want to lend. It's just about making sure you're in the best position as possible to kind of make a successful application. And that's what any mortgage advisor is there for, to help you to do that.
Brilliant. Well, thank you for talking to me today. And I hope to have you back. We'll talk about other areas of the market in the future.
Brilliant. I'd be delighted to. Thanks, Ben. Thanks so much.
Find your new home with Churches Estate Agents. Our expert valuation team can help you find, rent, or sell your property as fast as you need. With our help, you'll find the best places and the most popular neighbourhoods. With Churches, you have all the support from the same senior agent throughout the lifetime of your sale. We have a licensed and highly qualified team that brings you trust and safety during the process. It is fast and easy to get your property on the market. Churches provide everything you need to professionally present your home. An exclusive platform and several media partners that improve our online reach. We do not charge you anything until your property is sold. We're proud of every house, apartment, site or land we sell. Are you waiting to start a new story in a new place? Talk to our team and live the best moment of your life. Churches, giving you more than a house, giving you your home.
Welcome back and thanks for staying tuned. Now it's time for this week's In, Out and Away. Each week we're comparing different properties in a city, on the outskirts of a city, and an away option somewhere out of town. This gives you an idea of where you could live depending on your affordability. This week we've got a bit more upmarket than last week. We have picked a price of €450,000 and we are going westbound from Dublin, starting in Dublin 8 and going all the way out through the deepest parts of Kildare. For our in property this week, this is 7 Oakfield Place in Portobello. It's on the market for €450,000. It's 1 bedroom, 1 bathroom, and 53 square meters. It's a little mid-terrace cottage. Now, from the outside, it doesn't look very much, but wait till you see inside. It really opens up into this beautiful high-vaulted ceiling living room with a kitchen behind. It has a really eclectic taste, which is fabulous. It looks like you're walking into a church. Now, from this, it appears there's only 2 main rooms downstairs, and the front living room is what they're calling a bedroom. But actually, they have a vaulted mezzanine on the upper floor in the attic space, which is decked out as a bedroom as well. So I'm guessing they're using that as the main bedroom, and the bed in the front living room is only placed there for official photos. This bedroom up in the attic is probably not officially a bedroom, and that's why they're not calling it there in the ad. Most people would probably see it and recognize it as a room they would use as a bedroom, but it's not technically within building regs or planning. Like most of these inner city cottages, you're barely getting an outside space. There's a little courtyard garden here with room for a few bikes, but not really much more. Despite its size, you can't fault this property's location. It's a few minutes from the canals, and Ivy Gardens and St. Stephen's Green is just around the corner. This could be a great option if you wanted small inner city living. For away this week, we are going to Saggart, which is a small village just on the outskirts of Dublin. It's just outside the M50 past City West, so a little bit further out, but it is within a good commuting zone. This is 55 Crossforge. It's on the market at $425,000. It's got 4 bedrooms, 3 bathrooms, and it goes to 150 square meters. So it's almost 3 times the size of that property in Portobello. This is a modern A3 rated property built on the corner of a modern estate. It has lovely slate finishes on the outside and otherwise rendered quite crisp and clean. It's been beautifully finished inside, very beige and brown kitchens and floors, but incredible amounts of space, including kitchen, dining room, living room, huge master bedroom with ensuite. Small-ish courtyard garden for a 4-bed house, but look, we're getting a lot more value for our money than we were in Dublin 8. Our final property is away. This is number 2, Leash Henry, just in Broadford on the outskirts of Kildare. It's almost on the Meath border. This is a 5-bed home for $425 as well. It's 5-bed, 3 bath, and it's C1 rated. It was only built in 2006. It's a lovely looking bungalow, quite quaint inside with country kitchen interiors and a lot of pine, but is on a much bigger plot of a garden than the previous property. So you could just go a bit further out. This is just over an hour commute to the outskirts of Dublin, probably a bit further if you had to go into the centre of town. So this is a real away option. You're still on the main M4 into Dublin, but this might not be a daily commute location. If you can work from home a couple of days a week, this would be ideal. So which of our 3 properties would you choose? The 1-bed inner city property in Portobello, the 4-bed modernist house on the outskirts in Saggart, or the away option out in the far reaches of the border of Kildare, 5-bed house with a lot more garden, all for under €450,000. Tell us on our Instagram page which one you would vote for. Now for new home versus old home. This week we're going across the other side of the country. We're going all the way to Galway City and even a little bit further than that. We have found a new build scheme just on the outskirts of Galway town called Glenavere. This is just about half an hour commute, not even on the outskirts of Galway. These 4-bed family homes go to about 190 square meters, really good size, start from €580,000. There's 2 remaining. They've been fitted with floors. They haven't been fitted with kitchens yet, so you can come in and put your own stamp on it. They seem quite large on the ground floor, good size kitchen, living rooms, and a bedroom downstairs. And then upstairs, they're dormered ceilings, so they're a little bit smaller on the space, but 3 good bedrooms up there as well. They're all on a decent 1/4 acre plot and a nice little community just on the road out of Galway. So we looked around to see if we could find an old home in the area that would be in a similar price range, and we found this beautiful house in Doon East. It's on the market at $550, so a bit of change there if you wanted to upgrade it. This is a nice square detached farmhouse looking property, although it was built in 2004 and that's got it up to a B3 rating. It's 5 beds and 4 baths and it extends to just over 200 square meters, so it's a little bit bigger than the new builds. It's on the market for $550. Now, inside is a little more dated. It isn't those clean, crisp lines like the new build. It's a bit of pine and a bit of old-fashioned decor. The bathrooms are sort of half-tiled in different all sort of colours. I think this needs an upgrade to modern tastes and standards. But just look at the amount of garden you get. You get a huge amount of outside space. And this is the trick, really, with older properties, even 20 years old, you get a lot more outside space compared to some of the new builds, which are squeezed onto smaller sites or more properties on the one lot. This is on 0.8 of an acre, backing onto some of the wild moors there, heading out on the road towards Clifton. It's still about half an hour from Galway City. So which would you choose? The new build A2 rated for 580,000 or the slightly older 2004 5-bed farmhouse? Tell me in our comments on our social media which one you would vote for. Now, in our final segment, we're going to go through the latest news that caught our attention this week. First, a headline in the Irish Times, Bank of Ireland to tighten home lending criteria amid rising rates. This seems like a bad news story. Now, all banks do a stress test whenever they are looking at your affordability of a loan. Obviously, with increasing rates at the moment, we just had another 0.75 interest rate rise from the ECB. The banks are going to be tightening their affordability checks, making sure that you can afford the loan if rates go up in the next year or so as they're expected to. So it's unsurprising. It is bad news for some people who will be either getting lesser amounts allowed to be borrowed or will not be getting a loan at all. So hang in there, watch out for that. One bit of good news, this in the Irish Independent, property market finally delivers good news for hard-pressed home buyers. This is optimistic, perhaps overly so. Price inflation is decelerating. That doesn't mean they're getting any cheaper just yet, they're just not getting as expensive as quickly. That may or may not be good news so far. House building is at a post-crash high. There'll be more new homes built this year than any year since before the last boom. Unfortunately, a lot of those are unbuyable new build apartments, which are just being bought en masse, so that isn't as good news as it may seem. Now, a final article that caught my eye, I was just so impressed. This is Dripsey Castle Estate. It's on the market for 2.9 million. It's a lovely old 15th century castle near Blarney in Cork, but they have managed to make it carbon neutral and energy efficient. And it's just given me hope that any home can be brought up to a high standard, even a castle which are notoriously drafty, cold and damp. All you need is a private river with your own hydroelectric plant and about 70 acres of woodland to feed the gasification boiler. But look, if they can do it, we all can do our bit to save some energy this winter. Thanks for joining us for episode 3 of the Irish Home Show. We've gone through savings and mortgages, and now next week we are going to be talking about the biggest lender in the Irish market. It's a bank that has no branches, it has no website, they have usually no interest rates. It's a bank that some of us are fortunate to have in our very own homes or in our childhood homes. That's right, it's Bank of Mum and Dad. A sizable chunk of first-time buyers are reliant on their parents to help provide money for their deposit or for their house purchase. We are going to talk to Alan Purcell from Cloud Accounts about how they can legally and tax efficiently lend you money or give you money to help you buy a home. We're also going to talk about other tax issues such as capital gains tax, perhaps if you are selling a family home. In addition to that, we're going to have our regular explainers, our features and our news, so please tune back in and follow and subscribe Irish Home Magazine and the Irish Home Show wherever you can. See you next week.